Okay, we'll get the afternoon started here. Hope everybody got a little bit of caffeine and carbs in them and feels good for a couple hours. Yeah, we're going to swing the topic over. Saw a really great baseline of topics you saw this morning, and pretty much always the third leg in this funding is equity. Of course, depends where you are in your staging. So I was really glad to see that setup that we all witnessed this morning. So yeah, we were here exactly 1 year ago, and feels like about 5 years since a year ago, to be frank. I mean, with the election and everything that we've seen going on, I've been in this business for about 5 years, and it's really been kind of an amazing year in every facet, from the administration changeover to literally, we've seen it from tariffs to the dollar weakening to stuff we saw last night go on. It's a hell of a time to be an entrepreneur and to deal with these multifaceted headwinds and sidewinds. We, as your advisors, that's what we're here to do, to try to sort that out and help you fight through that. And today, I'm going to do a mix of a discussion. I'm giving a little bit of instructional stuff, but a lot of the value is going to come from, we have really three dynamite panels. And these folks are living in it just like you are today. They are funders, and they're all live founders who are raising funds right now. We're working with them closely, so you're going to hear it live from the street. And they're dealing with all those facets that I just mentioned. So it's quite a time. Also do want to say hello today. We have about 30 or so folks out in the Zoom world. So thanks for being with us this afternoon. I really appreciate the folks being here. We have everybody from Wilmington to Asheville to Greenville to Winston-Salem, Charlotte. So really great turnout here and online. And just one other plug to the ecosystem itself here. If you've not yet plugged into it, you have to. It's an incredible asset base you have here. You've seen most of the speakers from at least some of the agencies here. We have partnerships with almost every one of them. So if you need to know more about NC Innovation, we meet with them quite often. We had 6 or 7 interns who worked for NC Innovation companies last summer, so we know them quite well. We work closely with CED and Grow, who's a really excellent early stage accelerator here. First Flight Venture Corp was here. Same thing, we do a lot of cross training with them. So SBTD is sort of a spoke and hub organization where we leverage and have a lot of nice relationships with other agencies around town. So I can't think of a request that I've seen here in a couple of years that we can't fulfill through either a reference, a phone call, an introduction. So anything that you need, please bring it to us. And we're pretty well wired. We've been doing business in North Carolina for 40 years. We have great relationships like we do with Hutchison Law. We know a lot of banks, know a lot of investors. So we're really a great one-stop shop for you guys. So you saw the strength of our non-dilutive team this morning. Andrea and I are going to present the equity services to you this afternoon. So I'm going to try to squeeze in some questions because that's where a lot of the value of this stuff goes. So let me just start with, this is how we configured this afternoon. So I'm going to give you a little bit of a background on us, and then really, again, a mix of experts here. You're going to see the first group is going to be funders. These are check writers who are very actively writing checks in this community. So you're going to hear it straight from them, what they're looking for, what they like, what they dislike, what they discount. Then we're going to roll over into founders just like yourselves. Really interesting mix here. We have social media, we have health tech company, we have a biotech company from Winston-Salem. So you're going to see all three sides of that, which should be interesting. Then a really, really important, something close to me too, is a women funders and founders group at the end. Previously, I worked this same position in Southern California 3 years, and I was a leader of a cohort of women founders there, and it's a hugely important topic that still gets woefully underfunded. It doesn't make any sense when you see the stats of how awesome women CEOs are, yet how difficult it is for them to raise funds. So really happy that we got this onto our agenda because it's extremely important topic. Myself, I'm a business guy, MBA, and then spent most of my career at large companies, mostly engineering and product development around the world. Last 9 years, I spent a lot of time in China in Vietnam, developing for a tech company in California. So I learned everything there is about those supply chains and engineering. So that comes in handy with some of our clients. I also own a company. I own a manufacturing company I bought about 6 years ago. So I'm in the trench just like you are, figuring out, you name it, the problems. The website crashes, the guy doesn't pay his bill, guy writes me a lousy review. I'm dealing with all of that nights and weekends. So, and then I've been lucky to be a founder or an advisor to funders and founders here for the last 5 years. So this is our team. I think you saw it earlier. Andre and I are, and again, we cover the entire state for the equity portion, and John and Ramya manage our non-dilutive. So this is, again, kind of a quick list of our services. I don't think you could stump us on anything that we couldn't help you with. This is stuff that we do in-house, or we can go out and get it for you, but intensely one-on-one focusing. A lot of other sources here are cohort-oriented. We are not. We are a one-to-one counseling, so we go where you are. If you are super early stage, need a lot of hand-holding and instruction, we're there. If you're very advanced and you just need an investor campaign done, we plug in and we'll do that for you. We roll up our sleeves. We do challenge a lot of our clients and what they're presenting. We want to make sure it's valid, the business plan's solid. We're fortunate, our group works out of Keenan Flagler Business School, UNC. So we have access to some really powerful subscriptions, which means really great research. So if you have anything in the arena of, hey, who's my competitors? Who's investing in this space? Who are the last 3 big rounds that came out? Come to us. We have a really awesome several subscriptions to help that, which will bolster your pitch deck. So we spend an immense amount of time in pitch deck development and rehearsal. Doesn't matter if you have a 5-minute stage pitch or if you have a 15-minute pitch with a VC. Anything you want to do, we rehearse the hell out of it. We'll help you create the slides, the narrative track. So we roll up sleeves and do quite a bit. And then the other side of the table is the funders. So this week, for example, we do a quarterly introduction to funders in the state. So I introduced 10 of our companies to about 95 different angel and VCs across the state. So we endorse them. We say, here's what we've done with the client. We supply them an executive summary, and we try to essentially have them contact the founder, set up the first meetings. Could be a pitch deck, could be a one-on-one, et cetera. So, and then once they get through that front door, we stay with the client, help them get ready for due diligence, whatever that could mean. We help them set up the deal room so they understand what the contents of a deal room should be, what could be missing. So really pretty much the whole lifespan from you to the investment, we're here to work with you, and we do. So today, really, this usually is a 6 or 7 hour session. So this is a total flyover, admittedly. This is really just to get you to engage with us. And we'll do all this with you one-on-one. But really today's just elevate your level. I know there's all different levels in the room here, from researchers to founders to mature companies. So we're just to try to get everybody on the same elevated awareness level. Hopefully you're going to get a lot out of these funders and founders. And really build in, we see kind of a weak spot with a lot of founders is they don't quite understand investor expectations. And they're pretty high, and they're growing higher. When I started in this business 5 years ago, it was incredibly low level expectations. Investors, this is pre-COVID, show up with a decent pitch deck, look decent, speak well, you probably get a $500,000 check. It was that simple. Now it couldn't be more opposite. The demands on founders to get that first check, extremely high. They want evidence, they want pre-sales, they want LOIs, they want de-risking to the maximum level. So that's turned this industry upside down in the last 3 to 5 years. So, and then really in the end, we're here just to help you maximize the value of the startup, whatever that means, whether you're planning a M&A or an IPO, whatever that is. We're just here to maximize the value. The state of North Carolina pays us to do that, to create jobs, create wealth, bring revenue into the state. So that's what we're going to focus on here today. You're going to get all this on a presentation. I think John's going to send out a big deck tomorrow. The Zoom folks, if you can just keep muted, and then we're going to ask you for just a little survey here at the end. So quick show of hands. How many first-time founders we got? Okay, good. How many multi-start founders? We got any of those brave souls? All right, there we go. Take note of that. Another set of hands. Who's just now in planning to raise equity? Okay, great. You're in the right place. How many already are out raising funds already? Okay, good. So that tells me. And then here's kind of a little bit of a trick question. Who thinks raising funds is the most important goal for founders? I'll be up there. There we go. Good mix. There you go. Sounds like voices of experience here. Yeah, you're not going anywhere without funding. That's for sure. So, but really the theme here is just simply, we believe in kind of block and tackle business building. Is the plan together? Is the tech together? Is the legal structure together? Is the IP all together? If that's good, then we start preparing you. Then we think you're ready to talk to an investor. It's pretty simple. You don't get that many swings at the ball with the investors, so you have to be extremely prepared. And that might take you 3 to 6 months. That might be really disappointing to hear, but we'd much rather have you have a higher hit rate and a conversion than a miss, because there's only so much limited capital and the competition for that capital is higher than ever. Extremely high competition right now. And one other just mindset for this is thinking these aren't your paying customers, but these are customers of your equity. You have amazing insights, you have IP to share with them, but they are going to buy, they're customers of your equity, of your insight. So you have to treat them like a customer. It's not necessarily a transactional relationship. It really is a customer that you have to really take care of in the most important way. So really the first question most people ponder in this area is, do I even want capitalists in this business? It's an easy thing to say, sure, I'm just going to run out and raise money. It might be the worst mistake you could ever make. There's many, many incredible businesses that have bootstrapped all the way to millions and billions, for sure. There's many who have taken on investors, and again, it's turned a business upside down and ruined their businesses if they weren't careful. I'm coaching a company right now, and I'm emailing with them 10 o'clock last night. They're extremely worried. They got a $500,000 offer from an investor in Chicago, and they're worried about bad vibes. They've had 3 meetings with this guy, and they're like, he's right, his background's correct. Why are we getting bad vibes for this guy? So that's the greatest thing you could possibly say. Bad vibes is probably a bad thing. Even though you might have to put up with, it's not your best friend, but bad vibes are bad vibes. So wherever you are in your business experience, you know what that feels like. And it gets really tough because you are in that valley of death. You saw the chart earlier today. That's a painful valley to be in. And here comes that first $500,000. To walk away from that's got to be one of the most painful things you could ever do. But it might be the greatest thing you could ever do as well. So answering this question really should keep you up at night, because it changes your life. It changes your family's life. A lot goes into this decision to go forward with venture capital. So just for clarity, I want to make sure everybody knows what that is. So venture capital is the venture capital is an industry unto itself, right? The venture capital industry. I'm talking about the venture, the capital itself, which is just simply money provided to investors from firms, individual accredited investors, but in exchange for long-term growth. Very, very simple. But they are a really critical source of this funding, because most companies in your early stages have no other source. You can't do an IPO. You heard Joel, very difficult to go to a bank in this fund. So you don't have access to a lot of capital. So this early stage venture capital, super, super important. They're taking on immense amount of risk. That's why they do so much diligence, of course. But they're expecting above average returns. They could go to the stock market this year, I just looked up this morning, NASDAQ's up 17% year to date, S&P's up 15%. Fall asleep and make 15%. Why should they take a shot with you? They all have portfolios, but they have lots of options out there. So they are taking a critical risk. So you'll hear more from these investors today, but really the point there is they're offering a lot to you. It's not just the funds. So most really great investors are bringing you technical advice, channel access, some other experience. How are you going to build your board? What type of funding should you be looking at next? So the selection of those early foundational funders is super, super important. So your diligence, and that's really vital. And there's also sort of worldview alignment too. Wherever you come from, whether it's a political spectrum or an economic spectrum, you're probably going to want to find some type of alignment. There's a lot of things to agree and disagree on with with investors. I'm an investor in 2 companies, and I've been fairly fortunate. I've been very aligned with the founders in the 2 companies I'm with. One's a baby food company. I have certain beliefs about that, but I'm exactly in line with what they're trying to do, and it's been great. And then I would surely say the other thing is once you get these great investors, they're your best mouthpiece because they've put their money where their beliefs are. They're not just believing you. Now they've written checks. So they are your credibility source, and they also usually are pretty well networked. So they can accelerate your fundraising quite a bit. So I guess the biggest question here is, so what makes something so investable? A great idea or a patent does not mean it's investable whatsoever. There's millions and millions of patents that never are invested upon. There's also trade secrets, there's trademarks, there's other various things, but that doesn't mean it's investable. But really the old school way, I went to MBA school a very long time ago, but it still has to be somewhat disruptive. You're finding a space nobody else is solving, and for a fairly big need that's growing at a decently fast rate. Certainly, they're going to scope you really hard on the management team, your experience, who are your advisors. Then again, how big is the market opportunity? The textbook on that is don't even bring it forth if it's not at least $1 billion market opportunity. And that could be global, that could be domestic, but either case, it has to be at least $1 billion, the opportunity itself. Then you get down to, well, then what's the serviceable part of that I'm going to compete in? And then what's the obtainable part called the SOM? So that'll carve out what is your plan. So if it's $1 billion market, you plan to get 8 to 10% of it, great. You will grow to an $80 to $100 million company. So it has to be a large and growing business opportunity. The business model could be very new or it could be very old and tried and true, but it has to be defendable. It's got to be a proven, not a crazy, complex business model that's almost impossible to understand. It's got to be very straightforward. We do this, and this is how we make money for our investors and how we bring value to clients. Traction, that's only gotten more and more important. I can't think of a check I've seen written in the last few years where there isn't some evidence of traction, even if it's not a piece of revenue per se, but there was an LOI, there's a memorandum of understanding, there's a trial, there's a beta, there's something there that an investor can say, okay, that's got the sparks of something that's going to grow. They need capital to get to the actual cash revenue, but it's more and more important. And then certainly scalability. Especially the angels that we'll deal with, they're not in this for a 3 or 5 times return. They're typically looking for 7, 8, 10. When I started in this 5 years ago, the minimum number was 15x return for angel investors. It's pretty high bar, but they're betting on scale. I would say those numbers have definitely come down in the last 5 years, but so they're looking for early returns on scale. Margin usually comes with it, but they're definitely looking for scale. So back to the issue of funding, how important is it? This is not me. This is giant industry survey that says the number one reason companies fail is they run out of money. It was laughed about up here on the previous panel. I'm raising non-dilutive because I needed money. Well, you do in the equity stages as well. So failing to raise is the death knell for a lot of great companies. So this particular area, how you plan for it and the partners you take on is the future of the company. You will not proceed if you're not successful in this part of the company. And part of your journey and venture. There's other contributing factors for sure. If you do a lousy job in customer discovery and you miss the mark, you might have the right widget for the wrong market. That's a big miss. And it won't go forward. You won't win. And you can see some other challenges, but still running out of funds is still the big problem. But so I want to swing more towards, okay, so then what? What type of funding should I pursue? I'm going to build on that here in a couple of slides, but I've seen some folks show up in our office who think they have it all kind of laid out, but they're kind of forgetting that really they have to understand the pathway, have to understand the type of funding you want, the type of scale that you're really trying to achieve with that specific round. Each round of funding is supposed to do 1 or 2 objectives. Not solve world hunger, not boil the ocean. You're trying to do one set of deliverables, usually with a round of funding. So that has to be really, really clear. And then I always say that, honestly, the other thing is what type of funding is, make sure you can answer that from the guy who's writing the check. because if you're not aligned with his theses, or he's got a portfolio to manage, he's got certain rules set up in his portfolio, you need to fit into his portfolio outlier, his outline for his portfolio. So if you don't, you won't get a check. So understanding that before you even get to that point is super critical. So the type of product, probably not a surprise to you, but wildly changes the type of fundraising and really the shortness of it. We have clients in all these categories. So right now, SaaS, it's not new, but it's pretty hot that you can go from zero to being in business in a SaaS business in 6 to 12 months. Great idea, spin it up, early raise, you're in business with a live beta, you've just installed it in 5 banks or a healthcare company and so on, but you can be to market pretty quick there. Other more developmental things that might take tooling, if you're working in textiles, stuff like that, it's understood that you're going to be in multi-year development because you have a lot of trial, you have a lot, sometimes it's just tool making, you have actually formulas, you have manufacturing processes to build. So that's a wild range of 3 to 8 years. And then a lot of the folks you heard earlier, and some in the room here, are in pharma, medical device, and so on. And that just by its nature is an extremely long track. Involves a lot of clinical trials typically, a lot of different FDA regulatory thresholds, which you're going to hear a little about this afternoon. So the product type really does dictate the number of fundraising rounds and the amount of fundraising rounds. Show you a couple examples. So, but before I do that, let me just make sure that we're all on the same page, because you hear these terms all the time and they're thrown around very liberally. In fact, I get confused on it some days. Someday a seed looks like a pre-seed round, and sometimes a pre-seed round drifts into a seed. So generally speaking, pre-seed rounds, these are really from the expectation of the investor. So they're looking for just a basic demonstrable concept in a pre-seed round. They're looking for the founding team. It's usually one strong founder. Hopefully it's co-founders. My experience is co-founders are hugely more successful in raising than a single founder. Solopreneurism is really tough, but it's certainly doable. Many great stories about that. And then some early customer validation. Again, it's just an early MVP with a little bit of reaction to it. Something that shows there's a chance to find product market fit. So that usually, I'll show you what these rounds look like in a second. Seed steps up quite a bit. In today's seed rounds, again, they are looking for proof of product market fit. You've been exposed enough. This shows that these customers are willing to pay the price that you're asking for, delivers the benefits they want, and it's a given. You can repeat the process and sell it. Certainly scaling that has to be provable at this point. That's why the seed rounds get much bigger. Again, think of this like they're mitigating the risks as they ramp up. So the next round over would have been a Series A, again, where they're continuing to de-risk. That's why they're ready to give you more money, because you're de-risking along the way, but you continue to show them a larger market and a growing market. So fortunately, there's no speed way to get through this stuff. So pre-seed is just that initially funding to get the business up and going. And the seed rounds are typically very focused just on validating the concept and just starting the early part of growth. Today, just some, and I'm sure these numbers swim around quite a bit, but on the tech side, I just showed you pre-seed rounds are could be as small as $500,000 up to today in our office. I see no more. That's usually around $2 million, something like that. And the seed rounds would jump up quite a bit. Especially these numbers have been rounded up a lot by AI ventures in the last 2 years, like hugely. These averages might be up like $5 or $7 million just because of the AI boom and in the tech side. And life science, again, pre-seed rounds, and I'll show you another drill down on that. And then seed rounds really step up. This is before they get to the big FDA rounds. So, but for you life science folks in the room, there's a lot of different areas of life science. So I just offered up a few different, you can see the big, long runways of therapeutics and biopharma. Pre-seed rounds are still rather large, and then seed rounds are even bigger because you are in some clinical rounds. Medical devices a little smaller, and diagnostics and digital health, you can actually get in somewhat. You can advance with relatively small rounds. So this is a chart I've pulled off of Carta, and Carta has a lot of free stuff out there. So if you want to get the landscape of it, go to, and have a really great LinkedIn as well. So this is just to put a little bit of a real dollars on it. So again, $500 to $2 million pre-seed round we just talked. So if you say the 50 percentile is about the median round, his companies are raising about $1 million to see $0.9 million. But for that, they've sold about 13% of their companies. So you can drift up and down across that and see how much of your company you're going to sell and how much funding will you raise. Then the next round is on the seed rounds. You can see significantly higher amount of cash raised, and also your dilution is going to drive up accordingly.
Kevin?
Yep, go ahead.
This might be a ridiculous question, but I was trying to figure out, is that a cumulative percent, or like, for example, if they got 13% on round one, is round two now equal 18, or is that 13 and 18 added?
Awesome question. It's and. So each round has its own set of dilution.
Thank you.
Yep, great question. So this is just pretty much the same slide, but this is just about C, but I wanted to show you as you build out through bigger stages, series A, Bs, and Cs. The black dot in the middle is kind of the median. So again, back to what you just saw, the seed round, typically you're giving up about 20% of your company at that point. So let's talk about the roadmap to get there. I use the word strategic here because you have to be extremely strategic about this. There's no willy-nilly, try some stuff and get together with a few of your friends and scratch out some stuff. I mean, this is very strategic planning, just like you were I was raised in a Fortune 500 background, and strategic planning is it. If you want to look like a public company, you have to act like one. So strategically planning how you're going to fundraise is super critical. So this is kind of motherhood and apple pie, but you have to take the time to do this stuff if you haven't done it already. So just the early vision, where is this thing going to go? And you probably don't know fully. You might have a nice piece of tech and I'm not exactly sure where this fits, but at least you have a sort of a vision statement. What general problem in this world are you out to solve? Generally, you'll define it. And then what kind of time frame? Do you have enough funds? Can you spend the next 3 years of your life? Like our buddy here this morning said, he didn't, well, back there, our friend from Atlantic, he said he starved for a couple of years living that. So you have to understand, is that a part of your life? Can you go and live very frugally and get through that stage? Really, really important question. Next is kind of what you're doing here today, really understanding that's a really defined process for fundraising, the types and sources of that fundraising, that's what we're here for. And then really the construct of these different types of deals, and I'll show you more of that in a second. Then, so once you get that plan in place, then we really the rubber starts hitting the road where we help you quite a bit, preparing stage. So again, repeat a little bit, but creating that storytelling, the pitch deck, the tools to go out and prepare to fundraise. How are you going to design your capital stack? I'll show you that slide here in a second. And then really start building, that's the reason you're here today, hopefully, is start building out networks. There's nothing more powerful in fundraising than networks, period. There's nothing more powerful. In-state, out-of-state, your alumni group, your best friend who lives in Silicon Valley now, all of that is critical. You never know where that next introduction is going to come with. So it's not the time to be introverted at all. You have to be extremely extroverted in this stage that you're getting ready to go out. So, and then the action stage is really where you're going to roll out there. So, and I can see some faces right here in the room. My friend Rob here is in this groove right now, facing off with investors, making the pitch. Danny's about ready to do it right here in Wilmington. And so that's the moment of truth. So just so you have this really, really clear stages, and they don't blend together. They have to be sequential that way. Some might take 6 months, some might take 2 years. Really depends. I'll kind of trail back to my very first discussion. I think one of the things said, why not just bootstrap? Don't worry about it. I'm going to go as far as I can with bootstrapping and I'll own it all. Fantastic. There's many multi-millionaires who have done that, but there's trade-offs here, right? So with that trade-off, here's a couple of them I just contrasted, and they're never this black and white, but in bootstrapping, let's say you have a somewhat limited background and you don't have a giant team, so your innovation by its definition is somewhat limited. If somebody handed you $3 or $4 million to increment to innovate on your thing, you're likely going to bring a higher value, a higher disruptive innovation to that. I'll jump down to sales. Typically, bootstrapping, you're probably going to be looking for sales partners. You might have some early reps or some distribution companies, but you won't have full coverage. When you do raise funds, you will be ready to go out and take on national networks of distributors, resellers, value-added resellers, wholesalers, whatever it takes to get your stuff to market. So that kind of funding lets you get out to the market quicker than bootstrapping typically. The team itself, I would say, almost every single deck that we develop, we see the good old pie chart that says use of funds. A nice chunk of the use of funds is talent. You're going to need talent to scale. There's no question about that. So the longer you stay on bootstrapping, it's only 1 and 2 you grinding, you're somewhat limiting your acceleration to market with that. And of course, the big bonus of bootstrapping is maintaining control. You're not answering to investors. You're not answering to anybody else. You drive it every single day, as opposed to sharing control, taking more and more inputs, which takes a lot of time. It certainly does. But in the end, again, see which side of the table I'm on. I believe, and I've seen it, that the angel and VC-backed activity does accelerate companies forward. So we're fortunate now. This is a very, very advanced market. So the different tools that you have to drive equity financing is incredible. So I think everybody's pretty aware of angels. Talk about that in a minute. And the venture capital industry is ginormous. Can't go anywhere without running into it. One new advance, though, actually has been crowdfunding. I was with a client actually yesterday who's actually doing $1 million crowdfunding round. Kind of striking because it's not a traditional crowdfunding as you thought it was a year or so ago. Investment crowdfunding is a really mature industry now. There's 3 or 4 really advanced platforms. We'll shed more time today, but WeFunder, Start Engine, these guys are out doing stuff for biotech companies, software companies, SaaS companies. If you go on these sites, you'll see $5 and $10 million raises that crowdfunding is doing. So investor crowdfunding, it's not, I developed a script for a Hollywood movie and it's not that at all anymore. But it's a way to get community involved, especially when you target a given community. I've been told it's usually in a capital stack at somewhere between like 10 to 15% of your whole, if you're trying to raise $5 million, 10 to 15% of that would be a healthy mix of crowdfunding. So put that on the table. Happy to talk about that some other day with you. So I referenced the capital stack a couple times. This is just one of hundreds of examples of our clients. You consider this particular company in this early stage was mixing classic equity shares along with a couple different things, which is a little unusual, safe notes and convertible notes. Usually you choose one or the other, as you heard John explaining, but this particular company actually did both. And they also had enough credibility and collateral to take on some debt. So that's how they cobbled together $2 million in a capital stack. And they might have had non-dilutive stuff on the side. So it's really important in your planning to think about all these different avenues because it's not likely you're just going to do it solely with an equity raise. It's one of my favorite slides. It's a little busy, but we're going to send you this deck, but it's a little bit of a repeat too. So each of these stages, and put yourself wherever this goes, left to right, and start thinking about the targeting. So on the other side of that table, right, the investors only want to be involved. They're very discreet. They are mostly seed investors or early in growth investors. There's very few I've seen that cover the entire gamut. So these folks, for example, in pre-seed, they want to be in that state. So family and friends and self-funding, even some accelerators so you've heard of Y Combinator and Techstars, things like that. There's small equity at the end of those things. They're really great for pre-seed. In the seed round, it's all the ones I've been mentioning here. Early angels, a lot of individual accredited investors. They operate sometimes in syndicates. And then again, investor crowdfunding. And then once you're pretty much in market and ready to really rev and go large, you can start bringing in VCs, large family offices. And now once you're really done, proven in the market, you're just looking for gas to put on to fire. Now you're talking to significant venture capital firms. Corporate venture is a giant category. There's about 600 of them in the US. These are large public held companies that have billions set on the side who are looking to invest, to grow. Instead of doing M&A, they do these kind of things. And then exits. You've heard quite a bit about this, even though it's been a really slow time for this. We'll talk about that. But again, the investor himself has just really tuned into this. This is a really great checklist that you have to meet their expectations. Again, they're your customer of equity. So think about really exceeding their expectations in this area here. So make sure, I'm sure it would be, but compelling idea and the extreme differentiation. Why is it different and why does it matter? You really have to have that story honed, really, really honed well. Got to have your own, even if it's your corporate background or your partners you brought in, but that founding team takes a disproportionate amount of focus in the early stage. Founding team takes immense amount of weight in an early funding round. So whether it's your PhD, you have a successful business, you're a doctor, or you're doing research at UNC, they're looking intensely at that. Not so much your business plan, maybe a little bit of your IP, but who are you? And then, of course, you got to show them something. So the MVP has to be at least demonstrable. It could be a video. Doesn't have to be a fully functioning MVP. And you're certainly, but you have some hopes of pre-revenue. That's always very, really important, early traction. And then proof that there is some market interest. You've done some surveys. You've done customer discovery. So there's evidence that this market, you found a hole in the market, and there's an economic trade-off. Somebody's willing to pay something for that new service. Then once you've done that, that's probably about a year or two right now. I think the average pre-seed round is about an 18 to 20 month runway. So you have about 2 years to take all that and get ready for a much more intense investor. So this next level intense investors wants it all. Product market fit. Is the thing product ready? Is it fully bundled and priced? Do you have the team built out to really, really scale the business? Do you have your financial house in order? By now you ought to have CFO. Having the fractional CFO is probably not good enough at the seed level. Are all your legal structures locked down in places? Now, I'm not sure where we're at with IP. No, these things are locked down. You're already a C Corp. You're set up. You're ready to go. You can't have any loose parts of this. And then can you demonstrate scale? Maybe it's a test. Maybe it's a pre-market, but you can actually, because these folks, remember, they want to be in it for the next round as well. They like you and you're doing well. They want to be in the A round, the B round. So performing here will keep these folks along for the ride. So I mentioned a good bit about angels. I know I'm running a little long here, but the angel world's changed quite a bit since even I've been in this for 5 years. I would say they've definitely put more mitigation out there on the founders themselves. They want more and more de-risking than you ever saw 3 years ago. So, excuse me, that means the bar is just raised higher and higher for you. To get that check, they want to de-risk as much as possible. It's a fair trade-off, but unless you knew what this looked like 3 years ago, it wouldn't matter to you, but it matters a lot now. And the scrutiny and the intensity on it's very high. And we'll talk about that in our panels here this afternoon. So I found this online, found it really cool, but you can imagine this is exactly what happens when you have that first meeting, Zoom call, live, they're going to score you. So you might think about these, it's almost like an old school SWOT, right? It's a strength and weakness grading system. You might take this and kind of score yourselves on it. Like, hey, how strong do I feel? Yeah, the team's looking good, but I'm not actually breaking away from competition well enough. So before you go and spend more time with investors, bolster up. You don't want to see on anybody's scorecard. It's a very easy reason to say no and come back. You don't want no and come back. You want yes and we'll work with you. So, but being honest to yourself and say, do we have any weaknesses? Do we have a weak set of metrics, or we don't have exactly deep enough proof yet? Work on that harder so you get all mostly A's and a few B's, because they will absolutely scrutinize these more than ever, far more than they have in the last couple of years. So, but I work with angels. That's my core group. They are the group for most folks in this room to stay focused on, but definitely most of them have some type of public website, something like that. So you can get inside of them. You can ask them to talk to portfolio companies they've already funded. Find out what is it like working with these angels. Are they in your face every day? Do they call you up once a year for for a rah-rah talk, or like, what is it exactly? Because you need a lot more than their money. You need their advice, you need their partnership, you need their kinship, you need an arm to put around you once in a while. So you can get that from references and other folks that they've invested in. And really, again, study their portfolio. If they've only invested in let's say, sports online gambling, and you're pitching a diagnostic, like, something doesn't look right here. Why are they here? And that comes up quite a bit. So just making sure that they're true to their investments is part of your own diligence. You're doing diligence on them like they will do it on you. Don't ever kid yourself about that. You have to do at least as much diligence on them as they will do on you. So this is, again, kind of motherhood and apple pie. I'm not going to grind you through this, but this is what SBTDC, we do this quite a bit. Testing your articulation of the idea, the team, the market, the business plan, and your funding plan. Is that all in order? That's just as we start preparing to face investors. And then we help you do this specifically. Who are these investors? Are they right for you? Help you get organized for that. We'll test you and your plan, your assumptions. We prep the pitch. We grind out really, really hard rehearsals, make sure there's no gotchas left in the pitch, and there always are, but we spent a lot of time on that. And then really engagement. So I mentioned last week, we sent out to, I think, about 95 funders here in North Carolina, 10 of our companies. So that's where the start of that is. They will do their own screening. They see hundreds of deals a month. I can't even tell you what the hit rate is on that, but it's pretty low. If you're invited into that, great, you'll have a chance to pitch, have a chance to meet them. They'll go through a process. And if you're really doing well, you'll get invited into some kind of due diligence process. I'll share what that looks like here in a second. So this is pretty much a due diligence process. It's about a 60 to 90-day process. Typically, they're going to start off with a business plan and a proposal. You'll get to present them. If you have a site, they'll certainly come out to your site. If you're a lab, if you're working at a university, they will definitely want hands-on. See, do you actually have a staff, or is all your staff sitting in some foreign country? Yes or no? So they do a lot of diligence on that. And then certainly there's going to be a period of diligence checks and the deal. So when you get through the front door, you're not going to get a check in 30 days. Just lower the expectation on that. There's a really defined process that you'll go through. I want to talk a little bit about, so that's kind of the mechanics, but you do have to put your place, where are you in time and place? And we are in a wild, unbelievable market right now. You've seen it all in the news here for the last 8 to 9 months. There's never been I've been in business 30 some years. I've never seen a more crazy market with uncertainty and risk all bundled around excitement at the same time. I'm sure you see in the news everywhere today, to the moment, we're living with higher inflation than we thought we were going to live with. And it's sort of starting to live with it. It used to be 2% was the Fed mark. Now 3% actually started feeling normal, which is kind of odd. Going through a decent period of GDP, but next year GDP expectations are kind of low. They're down into low mid ones, which isn't great, but you got to know that. You've seen all the stuff with downsizing. So if you're a company selling into the federal government, watch out. They're not done with that yet. So call it Doge, call it whatever you want, but that part of the regime is still going on. So be careful where you are in that, but there's other sides of government that are booming. DOD is exploding with investments in technology right now. So depends where you are on that. Needless to say, I think I read a couple days, 52% of all the VC money in the entire country is either AI or AI related right now. That's not new. It's been a 2-year trend. So if you don't have AI attached to your business, you've cut your chances in half right off the bat. Even though you have an awesome product, something else, the investors' mindset are so overweighted to AI right now. They're actually, it's ready to take its downturn a bit. The infrastructure of AI is being built out rapidly. You see it on the news every night. Now we're moving into a lot more interesting ones. But before I get to that, sorry, I jumped. M&A, so the two routes out of all this, your exit is either probably going to come through mergers and acquisitions. Somebody's going to bolt you on to their business or buy you, or do an IPO. There are great hopes for that coming around this year. Neither has really manifested much. There's been a little bit of M&A. You've seen just a few flashy IPOs in the news, but it hasn't lifted like we were really hoping 6 or 8 months ago. So that's, if you're in that business today, I'm a private investor in a company that's been waiting 8 years, and they announced their IPO yesterday. So I'm with this 8 years. And surprisingly, they broke out. It's a food company, which isn't really popular in IPOs, but yesterday they announced. So no crystal ball on where the IPO market's going. But just so massive, trillions of dollars of capital flow going into tech companies right now. So if you're in anywhere in tech, you're in the right spot. Really interesting different models coming forward. Different exit models. You've heard this new phrase called acqui-hires. They're not actually buying Silicon Valley, especially they're not buying companies for the IP. They're buying for the talent. They have 3 killer engineers and a genius founder, and they'll give them $100 million contracts each. There's not thousands of those going on, but there's lots of them going on right now. So that's something that didn't even exist a year and a half ago, acqui-hires. Another new thing that's really exciting I see, maybe a little treacherous, but imagine that a year from now, 401ks are actually going to be now they cannot invest in private markets. They can only invest in publicly traded funds and so on. Imagine that a year from now, they're going to be able to invest 401k monies in a teachers union or any private company, public company, into a private company. That's amazing. So God knows how big that bubble is going to be, and you could be in that bubble, drawing in those type of funds. So I think that's super exciting. Tech, I won't bore you with all this, but AI, anything right now, we're on the agentic phase of AI build out, massively exciting in everything from life science to fintech to cybersecurity, you name it. So the agentic move is on. Voice, I'm hearing tons and tons about voice now, and it's a lot more than just Alexa and Siri, way more than that. But it's advancing really rapidly. Surprising comeback of crypto. I think you've all seen it in the news, not just because our president's interested in it, but crypto is maybe becoming legitimate. It's a very interesting form factor that might be a new source of funding. Certainly blockchain has been out there for a while, but it's advancing as well. In our office, we see a ton of defense tech coming. So the merger of standard tech and defense tech, not just warfighter stuff, but a lot of other very, very interesting stuff that can go from cyber all the way to growing food. DoD is highly interested in different areas like that. So just one more drill down on AI. This again, coding in AI agent copilots is booming, and that's really by each sector. So almost every single vertical now, whether it's biotech or fintech, cyber, these coding agents are just booming for retail as well. Enterprise workflows, that's been happening for a year or so, and that continues to work. LLMs are booming, but now the big trend is not the large language. It's very narrow, but very deep language model. It's very specific, where you can train a specific language deeply. So there are a lot less hallucinations, a lot more specificity around it. So ChatGPTs and Perplexity will be around, but these kind of LLMs are really going to be where it's happening in the next few years. This is just to show you where we are in the market right now. This is across everything through August. So you can see a downline, which isn't great. So the height of all this was crazy times in 2002. So I wouldn't look back that far, but I would say market normalized about in the middle of 2023. So you're still seeing a downline, which isn't great, but it's not a crashing line. So that's, again, this is early stage deal funding. And this is, since they call it zero interest based policy, this is deal activity month by month. So I just tied it straight back to, you can see August, September of last year. So it's down, not great, not happy about that, but it hasn't fallen off the cliff. Most of these are pretty, we'll call it small deals, so up to seed round deals, less than $10 million. It's pretty much where the bulk of deals are happening. This now I'm zoning into just RTP specifically. So I'll show you where all this comes from in a minute, but we have a really great resource here in town called Deal Room. And this is a snapshot I just took the other day. So that's up to the minute financing that's been reported here just in RTP. So $1.8 billion so far this year. And you can see the different scales. We had a couple of very large deals. And then you can see down into the low. So 4 to 15 million, 1 to 4 million, and 0 to 1. That's about $120, $130 million, which is about on par with previous years. I know it's an eye chart, but this is just to demonstrate RTP has been very diverse. You see real estate deals here, fintech deals, energy deals, et cetera. So RTP is a fantastic place to be. We have resources, we have reach, very wide appetite for different type of businesses here. You'll get this deck, but definitely go on here. They have a free and a paid version of this, but you can do this. CED rented this platform and has populated it for anybody in our ecosystem, and it's fantastic. You can slice and dice it any way you want, by your vertical, by the company. It actually has a nice list of investors on there, so extremely useful asset you can walk out of here with.